Exchange traded funds, ETFs, and stocks are both investment options, but they have several key differences. Here are the top 3 differences between ETFs and stocks. Number 1. Diversification versus individual stocks. A guide to ETFs versus stocks. Investing in financial markets offers individuals multiple opportunities to increase their wealth. 2 of those commonly used investment vehicles are ETFs and stocks. Each one has its unique advantages and disadvantages, with the central distinction being the trade-off between diversification and individual ownership. Diversification with ETFs. Exchange-traded funds are often hailed for their ability to provide diversification. But what exactly is diversification and why is it important? Diversification is the practice of spreading your wealth across various assets or asset classes to reduce risk. The idea behind diversification is very simple. Don't keep all of your eggs in the same basket. By holding a diversified portfolio of assets, you can potentially mitigate the poor performance of one asset or one sector. ETFs are designed with diversification in mind, making them such a powerful tool for investors to use who want to expose themselves to multiple assets simultaneously. Here is how diversification works with ETFs. Number 1. Broad market exposure. ETFs can track various indices such as the S&P 500 or the MSCI World Index. By investing in these ETFs, you gain exposure to a broad range of stocks or assets. This diversifies your investments across different companies, sectors, and geographic regions. 2. Risk reduction. Because the ETFs hold a basket of assets, the performance of one poorly performing asset can be offset by the others that are doing well. Now, this can lead to more stable and less volatile returns as opposed to investing in individual stocks. 3. Simplicity. Diversifying with ETFs could not be simpler. You buy the shares of the ETF, and it is up to the fund manager to diversify the portfolio and to help track it against the index. 4. Lower costs. ETFs typically have lower expense ratios compared to actively managed funds, making them a cost-effective way to achieve diversification. Individual ownership with stocks. On the other hand, individual stocks represent a form of individual ownership of specific companies. While this approach lacks the inherent diversification of ETFs, it does have other unique advantages. Let's go through them. Number 1. Focused investment. When you invest in individual companies, you are betting on the performance of specific companies. Now, this approach can be very beneficial if you've got strong convictions about the future prospects of these businesses or industries. Number 2, potential for high returns. Successful stock picking can lead to high capital gains. If you identify a company with potential growth before the market does, the rewards can be substantial. Imagine if you picked a new Tesla before everyone else did. Number 3, active management. Owning individual stocks allows you to actively manage your own portfolio. You are in the driver's seat and you are the one that decides when you should buy or sell according to your analysis of the market conditions and company fundamentals. 4. Dividend income. Now, some stocks pay dividends, and this could provide a steady stream of passive income to the investor. Dividend stocks can be attractive for income-focused investors. So what's the trade-off? The choice between ETFs and individual stocks ultimately boils down to your own investment strategy and goals. Long-term investors. If you're a long-term investor with a preference for simplicity and less risk, ETFs are a valuable tool providing broad diversification. Active traders. Now, if you enjoy researching and analyzing individual companies and you actually have the time to actively manage your investments, then individual stocks may be more appealing to you. A balanced approach. Many investors, they adopt a hybrid strategy, combining ETFs for broad market exposure with a selection of individual stocks that align with their convictions and interests. Risk tolerance. Now, your risk tolerance plays a crucial role. ETFs tend to provide a more stable and reliable returns, while individual stocks can be riskier but provide potentially higher returns. In conclusion, diversification versus individual ownership is not a one-size-fits-all approach. Both ETFs and individual stocks should be a part of a well-balanced portfolio. The key is to understand your investment objectives, your risk tolerance, and the level of control you want to have over your investments. Liquidity trading, a comparative analysis of ETFs versus stocks. Liquidity and ease of trading are essential factors that investors should look into before deciding between ETFs versus individual stocks. Both investment options have their unique characteristics, advantages, and challenges. Understanding liquidity. Liquidity refers to the ease that an asset can be bought or sold in the market without greatly impacting its price. In essence, it measures how quickly you can convert an investment into cash. High liquidity typically means tight bid-ask spreads and the ability to exit or enter positions without causing substantial pricing fluctuations. ETFs, a liquidity advantage. Number 1. Intraday trading. ETFs are known for their high liquidity. They are traded on stock exchanges throughout the day, just like individual stocks. This means that you can buy or sell ETF shares at market prices during trading hours, giving you flexibility in the timing of your trades. Number 2. Tight bid-ask spreads. ETFs generally have narrow bid-ask spreads, which means the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is asking, ask, is small. This reduces the cost of trading and enhances liquidity. 3. Market orders. For most ETFs, you can use market orders, which execute immediately at the current market price. This can be advantageous if you need to act quickly or when trading high liquidity ETFs. Liquidity variability. Number 1. Diverse liquidity. The liquidity of individual stocks can vary significantly. Blue chip stocks of well-established companies tend to be highly liquid because of substantial trading volumes. In contrast, the small cap stocks, or those of less well-known companies, may have lower liquidity. 2. Market hours. Just like ETFs, stocks are traded during the market hours, but the liquidity outside of these trading hours can be limited. This means that if you need to trade a stock when the market is closed, you may experience delayed execution and potentially less favorable prices. 3. Wider bid-ask spreads. Less liquid stocks may have wider bid-ask spreads, leading to high transaction costs. Traders need to be mindful of these spreads, as eventually they can erode the profits that you make in the long term. Factors affecting liquidity. Several factors influence the liquidity of ETFs and stocks. Number 1. Trading volumes. High trading volumes usually indicate a higher liquidity. ETFs with substantial daily trading volumes tend to be more liquid. Company size. Larger companies usually have more liquid stocks due to their widespread investor interest. Market conditions. Liquidity can fluctuate based upon overall market conditions, economic events, and investor sentiment. News and events. Company-specific news and events can impact liquidity in individual stocks. Significant announcements can trigger sudden price changes and increase trading volumes. Choosing the right investment. The choice between ETFs and stocks, considering liquidity and trading, depends upon your investment goals and strategy. Liquidity priority. If you value liquidity and want to execute trades quickly and efficiently, ETFs generally provide an advantage with their intraday trading and their tight spreads. Stock selection. If you have a particular stock picking strategy or you want to invest in individual companies, stocks may be your preferred choice. However, be aware of varying levels of liquidity on the stocks that you pick. Risk tolerance. Consider your risk tolerance. Highly liquid assets like ETFs can offer stability, while less liquid stocks often comes with more risk. Diversification. ETFs often provide instant diversification, which can be beneficial if you want to spread your risk across multiple assets. So in conclusion, liquidity and trading are essential factors in the investment decision-making process. ETFs offer high liquidity and ease of trading, making them suitable for many investors, particularly those looking for diversification and intraday trading flexibility. On the other hand, individual stocks may be preferred by those with specific company-focused strategies, although they come with varying levels of liquidity. Ultimately, the choice between ETFs and stocks should be aligned with your investment goals. Management and expenses. A comparative analysis of ETFs and stocks. When considering investment options, it's crucial to understand how management fees and expenses play a role in the overall returns. ETFs and individual stocks differ significantly in terms of how they are managed and the associated costs that go along with it. So let's explore management expenses for ETFs and stocks to help you make a more informed investment decision. ETFs. Passive management and low expenses. One of the key features of ETFs is their approach to management expenses. Number 1. Passive management. The majority of ETFs follow a passive management strategy. They aim to replicate the performance of a specific index or asset class, such as the S&P 500 or the bond index. Now, this approach requires minimal active decision making by the fund manager. Instead, the ETF portfolio is structured to mirror the index that it tracks. 2. Lower expense ratios. Passive management typically means lower expenses for the ETF investors. The expense ratio, which represents the annual cost of managing the fund as a percentage of assets under management, is often lower for ETFs compared to actively managed mutual funds. This can lead to cost savings over the long term. 3. Transparency. ETFs are known for their transparency. Investors can easily access the information about the ETF's holdings, asset allocation, and performance. This transparency allows the investors to make informed decisions about their investments. 4. Tax efficiency. ETFs are structured in a way that can increase the tax efficiency. They tend to generate fewer capital gains distributions compared to actively managed funds, which can result in lower tax liabilities for investors. Stocks. Individual ownership and no ongoing expenses. Individual stocks presents a different perspective on management expenses. Number 1. Individual ownership. When you invest in individual stocks, you become a shareholder of that company. You don't incur ongoing management fees as you would with a fund. Instead, you have the potential for capital appreciation through the company's performance and the receipt of dividends if the company pays them. 2. Active decision making. Owning stocks requires active decision making on your part. You must analyze individual companies, industry trends, and market conditions to make informed investment decisions. Now, of course, this approach offers more control. However, it will take up more of your time and research. 3. Transaction costs. While there are no ongoing management fees for individual stocks, you may incur transaction fees when you buy or sell the shares. These costs can include brokerage commissions, which can vary based upon your trading platform and the trading volumes. Choosing the right investment. Long-term investors. If you prefer a hands-off approach and lower expenses, ETFs are often an attractive option. They're well suited for buy and hold investors who want to capture broad market trends. Active traders. Individual stocks are suitable for those who enjoy active decision making and want to leverage their research and market insights. However, be mindful of transaction costs and the time commitment involved. Many investors adopt a balanced approach, combining ETFs for diversified exposure to broad markets with individual stocks for more targeted investments aligned with their convictions. Risk tolerance. Consider your risk tolerance. ETFs offer diversification, which can reduce risk, while stocks offer a more concentrated exposure. In conclusion, exchange-traded funds, ETFs, and individual stocks represent two distinct, valuable investment options, each with its own set of characteristics and advantages. Ultimately, your decisions should align with your investment strategy, goals, and risk tolerance. ETFs are favored for the diversification, liquidity, and cost efficiency, making them suitable for a wide range of investors, particularly those seeking a hands-off approach to investing. In contrast, individual stocks offer the opportunity for targeted investments and active decision-making, appealing to those who enjoy research and analysis. Your investment choices should reflect your unique financial situation, no one else's, just yours, and objectives, considering the trade-offs between diversification, liquidity, and costs. And that's it. I hope you found some useful information in this. I'm learning as I go along here as well, and I'm hoping you can take something from this as well. If you did, I'd appreciate a thumbs up, hit that like button, leave a comment, and I'll come back to you with another TIG video shortly. Cheers, guys.